Hey, what's going on YouTube? Welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Moomoo. Right now, you could earn an 8.1% APY on your uninvested cash by using my link in the description below. You could also get up to 15 free stocks right now. Keep in mind, terms and conditions do apply. So go ahead and check out Moomoo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. So I'll put a link to the Discord in the description below as well. Now let's get right into today's video. So today I want to talk about how to sell calls without owning 100 shares of the stock. Now, firstly, why would someone want to sell calls without owning 100 shares of the stock? Well, one big reason might be because buying 100 shares of a stock sometimes costs a lot of money. So let's take Alphabet as an example here. Ticker symbol GOOG, also known as Google. If I wanted to buy 100 shares of Google right now, I would need $19,325. And then I would be able to sell calls on those 100 shares. Well, maybe I don't have that amount of money. Maybe I'm, trying to sell calls on a different stock. Maybe that stock needs even more money to purchase 100 shares. So maybe we don't have the money needed to purchase 100 shares to then be able to sell calls. And so in today's video, I'm going to show you a potential alternative that will require you to only have a fraction of the amount needed to purchase 100 shares, and you'll still be able to sell calls. So what I'm going to do is I'm going to go into the options here for Google. Again, everything I'm showing you here today is just an example. And so the first thing we need to be able to do here is we need to be able to somehow mimic owning 100 shares of the stock. And one way we can do this is by buying a deep in the money call. So here we are on calls, and we need to buy a deep in the money call. Now remember, for calls in the money is going to be the call options whose strike price is less than the current share price. So all of these are going to be the in the money call options. So when we say deep in the money, we mean all the way down here. And remember, the deeper in the money you go, the more the call option will act like 100 shares of the stock, because delta is going to get closer to 1 the more deep in the money we get. So remember, if I click on one of these options, we have the Greeks, and under the Greeks, one of the Greeks is delta. So for example, this in the money call option for Google has a delta of 0.9725. And remember, each call option controls 100 shares. So we need to multiply this by 100. So we get 97.25. So remember, what that tells us is that if I buy this call option and Google goes up $1, the value of this option will go up by $97.25. If I buy 100 shares of the stock and Google goes up $1, then I would be up $100. So it's almost the same. And again, the deeper in the money I go here, you'll notice that it gets even closer to a delta of 1. So for example, this one, if I buy this deep in the money call and Google goes up by $1, the value of this call option would go up by $99.15. Almost the same as if I were to purchase 100 shares of the stock. So that's why we need to go deep in the money here. We need to purchase a deep in the money call. And so I try to stick with options who have a delta of at least 0.9 or higher. We also need to go far out with our expiration date here. generally a few months out. And so for today's example, I'm going to go out to April 17th, 103 days out. So more than 3 months out here. And so I'm going to go ahead and I'm going to go deep in the money here. I'm going to go to the call option at the 155 strike. So this has a delta of basically 0.9 here. So again, if I buy this call, Google goes up by $1, the value of this option should go up by about $90, right? Close to what you would get if you purchased 100 shares. So that's the first step. So I'm gonna go ahead and buy this deep in the money call here with a further out expiration a few months out. So for this example, I selected April 17th. So now that we've done this, now that we've added our long call here that's going to mimic 100 shares of the stock, we can now sell a shorter term call option against this deep in the money call. And so I'm going to go to, let's say, January 17th, so 13 days out, and I'm going to go ahead and sell a call now. And so we're going to sell a call that's out of the money. So for today's example, I'm going to select the one at the $200 strike. So remember, out of the money for call options is going to be the options whose strike price is greater than the current share price. So all of these up here are out of the money. So now we have our call that we're selling here that's out of the money. And since we're selling a call option, make sure that you're aware of early assignment risk. I'll put a link to a video I've made on this topic in the description below. It's a very important topic you should know if you're not aware of it. Now, our ideal situation here then is we want the stock to rise slightly to the strike of the call that we are selling. So what I would want, right, before January 17th here, for this expires, is for Google to slightly go up to $200. So that at expiration, this call that we sell expires worthless, which means we keep the entire premium, and the deep in the money call we bought goes up in price. And so this means that whatever stock we're using the strategy on, we want to be neutral to slightly bullish on it. So again, ideal situation here, I would want Google to go up to the strike of the call I'm selling to $200 at expiration. And again, the call that I'm selling would expire worthless. I would keep my premium, and the call that I bought would hopefully increase in price as the share price goes up. So let's actually go over to Option Strat to visualize what this trade looks like and talk a little bit more about a couple of different things. So let's head on over to Option Strat. So I'll put a link to Option Strat in the description below. Really great options visualization tool. So I'm going to go to Build, and I'm going to start with my deep in the money call. So let's go to the stock we're using for today's example, GOOG. And again, we start by buying a deep in the money call that should be at least a few months out with its expiration. So I purchased the call expiring on April 17th, and I went deep in the money. I went to 155, so that has a delta of around 0.9. So again, this acts as if we owned 100 shares of the stock. And when we sell the call, we can sell the call because we're buying this call with a further out expiration. So in case we do get assigned the call that we're selling, we have this call that we bought that can be used to cover that assignment. Now, the next step here is we also sold a call now, right? We're selling our call to collect our premium. Should have a shorter expiration date than the call that we're buying. And so I'm going to go ahead and change my expiration. For today's example, I used January 17th, and I sold the call at the $200 strike. So it should be an out of the money call option. And again, the ideal situation, we want Google to slightly go up at expiration of the call we're selling to the strike of the call we sold. And basically want the call we sold to expire worthless. And again, the call we bought to increase in price. So let's actually take a look at this here. So we're entering this for a debit. The debit is going to be the amount that you paid for the call you bought minus the premium you received for the call you sold. That's how much you're going to enter the strategy for. You're paying a debit. That debit is going to be your max loss. Then we can see our max profit here. Again, this will happen. Our max profit will happen if at expiration the stock is at the strike of the call we sold. So in this case, at $200 at expiration, our max profit would be $700 for this example. If you have the premium version of Option Strat, we can see our chance of profit there for this example, 53% according to Option Strat. And we can see our break even here as well. So at expiration here, at expiration of the call that we sold, which for this example is January 17th, there's many different options you have at that expiration for the call that you sold. The ideal situation, right, if you want to continue this strategy, again, would be for the call you sold to expire worthless. So you collect that premium you received, and then you sell another call again, right? So let's say January 17th comes up and this does expire worthless. I could sell then another call for the following week, January 24th, or maybe 2 weeks out, January 31st. And I can continue to do that as long as, I have this call that I bought and the call that I'm selling has a shorter term expiration than the call that I bought. But there's a couple of other options you have, right? You could also just close out the entire position on January 17th. So, you would close the call you sold, you would close the call you bought. Maybe you made a pretty good, decent profit. You're happy with it. You could do that. Another thing you could potentially do is, you could close the call you sold and maybe you're very bullish on the stock. Maybe you just want to leave the call you bought alone and let it increase in price as the share price goes up. So there's many different options at expiration here of the call you sold. But again, if you want to continue this strategy, the ideal situation here is you continue to sell calls against the call you bought, collect that premium for multiple different weeks here. And so this is called the poor man's covered call. This requires a lot less money than if we were to have purchased the 100 shares of Google, right? $19,000 versus only $4,000. That's a lot less money. But of course, you need to be careful here as, instead of owning 100 shares, which you could theoretically keep for as long as you want, here you're buying a deep in the money call, which has an expiration date. So this will have to expire eventually. And so it's not like you can hold it forever like you could with, for example, 100 shares of the stock. That's one of many different things you need to consider when using this strategy. So anyways, if you have any questions, feel free to leave them in the comments section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.